So the Fed owes $157 billion to the US Treasury. That doesn't sound like a very responsible bank, nor does it sound like a very profitable venture for the US Treasury that's owed all this money. And the timing couldn't be worse, guys. The federal deficit year to date is $830 billion. So if there was ever a time that the US Treasury could use $157 billion that it's owed, it's right now. But unfortunately, the Fed owes this much money, $157 billion, as a result that it is not only not profitable, but it's hemorrhaging money. And it's hemorrhaging money because we all know the Fed has been building up its balance sheet. It's been buying assets, not just securities on the open market, but also a great deal of government bonds. Now, it earns revenue, right, on the interest gained from those securities, but over the last couple of years, since 2021, it has been reducing its holdings of securities. And so the revenue made from these securities is going down. And this has come at the same time that the Federal Reserve has also raised interest rates. And of course, that means it has to pay out higher interest rates on its own facilities, like the reverse repo facility, the interest on reserve balances, and things of that nature. And so as a result of this major unprofitability because of QT combined with higher interest rates, the Fed now owes $157 billion to the U.S. Treasury. Not only are we running an $830 billion year-to-date deficit, but this also comes at a time when our annual interest expense is now above $1 trillion for the very first time. You can see here, I'm hovering over it with my cursor. Let's see, 2016 up through early 2018, we were less than half $1 trillion. And then in less than 6 years, or a little bit over 6 years, I suppose, we have doubled the annual interest expense. And again, look at the magnitude of what the Fed owes the U.S. Treasury. $157 billion, $1 trillion annual interest expense. I broke this down. Can't remember if it was in an article or in another video that I did last week. But the reality is here, folks, spending is off the tracks. It's not going very well, but also it's not going to slow down. And it's not going to slow down because the economy needs to continue being propped up by huge amounts of fiscal spending. So with this huge interest expense, with this massive deficit, what on earth is the Treasury doing to fund the U.S. government's operations? Well, one thing is for certain, we're not lowering the budget at all. We raised the budget, actually, $7.5 trillion for the fiscal year 2024, which is $800 billion higher than estimates, if I'm not mistaken. And also it's more than we spent during the COVID lockdowns. Not going to call it a crisis because they were government-induced lockdowns. And 2008, of course, by a wide margin. So we're doing crisis-level spending, but it's not a crisis, and we're running a historic deficit. So the plan isn't to lower spending. The plan is to obviously collect tax receipts, but also to make up for that funding gap, to raise the bill issuance like there's no tomorrow. So raise the pace of bill issuance. Of course, bills are any U.S. Treasury debt that's 1 year in length or shorter. And the plan is to, well, this is what they have been doing, is to raise the amount of bills that are being issued onto the open market in any given week. So this is in billions of dollars. This is the weekly amount of bills that are being issued. And again, these range from as low as 4 week to as high as 52 week, but we'll just focus on the headline number for now. This is the amount of bills that are sold. So as of last week, the amount of bills that were sold were $422 billion. Excuse me. And during COVID, okay, so at a point where the economy was in a slump, okay, and it made sense that we needed to fiscally stimulate the economy, bill issuance was at $170 billion a week. So right now, when the economy is rip-roaring hot, by all accounts, okay, I know prices are high, it's bad, but the way the powers that be interpret it, unemployment is historically low. You have price inflation that's close to target, but you have, by all accounts, an economy that's doing okay, an economy that's doing well. Asset prices are soaring, okay? And bill issuance at the height of when we literally shut the economy off was $170 billion a week. And now we're at $422 billion a week. So more than double what we were spending during COVID, okay? If we're talking just about raw bill issuance. And mind you, this is also at a time when tax receipts were down because people were getting laid off. So the economy was in the dumpster. It was in the dumpster, and we were we were selling $170 worth of bills to fund ourselves each week. Now the economy is rip-roaring hot. Not only that, but interest rates are way higher. And we're selling more than double that amount of bills each week. So why? Why? What on earth are we doing? Well, we're fiscally stimulating the economy even while it's doing well. Even while it's doing well. And so what this has led to is not just extremely good economic activity, but it's led to this huge increase in asset prices. Okay? So this massive surge in spending. Now, what's going to happen here? Okay, what's going to happen here? We have huge bill issuance that's obviously pressing yields higher. The Fed is increasingly stepping out of the market, and these are the holes that it has created, right? It now owes the Treasury $157 billion, and it's running down its balance sheet, so it's reducing its holdings of US Treasuries. So what's it going to do here? Well, the thing is, the Fed cares more about stocks and financial stability than they do about full employment and stable prices. You've heard it for ages. The Fed's dual mandate, they care about full employment and stable prices, okay? So the unemployment rate and CPI inflation, okay? So price inflation. That couldn't be further from the truth. If you look at, well, at least they take a back seat to stocks and financial stability. If you look at their behavior during 2008, during 2019, and 2020 and 2021, the three major financial crises that we've had, they've cut rates the moment that they witness financial instability and the stock market falling, okay? So here you see in 2008, the S&P 500 fell, the Fed cut rates. The S&P 500 was still rising during this time, but there was a financial instability crisis in the repo market, the Fed cut rates. And then right here, when the stock market cratered as a result of the lockdowns, the Fed cut rates. Okay, so the Fed, all the Fed cares about in its action, and you could judge, they say they care about full employment, stable prices all day long, but we're about to cut rates while price inflation is still above 3%. So they don't care about stable prices more than they do about financial stability, which is the reason cited by the Fed to start cutting rates in anticipation of potential financial instability still to come. Okay, so this is what the Fed cares about. The Fed cares about financial stability. They care about it more than full employment and stable prices. And so with bond issuance through the stratosphere, who on planet Earth is going to buy all these things? Is the Fed going to allow yields to spike to 5, 6, 7, 8, 9% potentially if no buyer can be found? Of course not. Of course not. And neither is the Fed going to allow the S&P 500 to fall very materially. As we've seen, they cut rates when the S&P 500 falls materially. They don't like prolonged recessions spurred on by asset prices falling, right? They want people to keep spending. And so what's happening with this huge bill issuance? Eventually, some of that money is going to have to come out of the S&P 500 in order to fund these bills. Otherwise, yields are going to go higher and higher and higher and higher, which leads to economic slowdown, okay? So any way you slice it, the Fed's going to have to step back into the market and begin a more active role in buying US Treasuries. And that's exactly what we've seen, frankly. I don't have the chart pulled up. I know it's probably the best chart to end this video on, but the reality is that the Fed's balance sheet has expanded time and time and time and time and time again. And so when we look at the problems forthcoming, the Fed sees financial instability, so it's going to cut rates. But also this huge bill issuance, okay, has driven yields very, very high, very high. And this has partly occurred as a stopgap because of how much the Fed has exited the US Treasury market. And so it's my belief that the Fed is going to step in. I wouldn't say any day now, but I think in this cycle, the Fed is going to step in and take a more actively managed role in the US Treasury market to prevent yields from spiking and becoming so attractive that the S&P 500 falls materially, because that's what they have shown time and time again is what they prioritize. So at the end of the day, here are the takeaways for you. The Fed's balance sheet is going to expand again. They're not going to be able to materially reduce it. It has been expanding. They've been doing QT and letting assets mature, but it has been expanding, okay? So at the end of this cycle, sometime before the cycle ends, the Fed is not only going to cut interest rates, which it's saying it's going to do by this June, even with price inflation elevated, even with the stock market roaring, because they care more about financial stability, and the Fed is going to step in and help buy some of these bills that, again, issuance is double what it was during crisis times. It's only accelerating in order to prevent capital from flying from the S&P 500 and inducing something like a reverse wealth effect, which would reduce spending and potentially induce a recession. So basically what I'm saying here with this video, with this long drawn out video, I felt compelled to make this because this is such a staggering number. The Fed owes $157 billion to the US Treasury. This can't continue. The Treasury needs to be funded. It needs to be funded somehow. And when times get tough, whether it's stock prices that initiate it, whether it's financial instability that initiates it, at the end of the day, the Fed always becomes a not so separate institution from the US Treasury. It gets a tap on its shoulder and it becomes the buyer of last resort for what the US Treasury has got in store. And it slashes rates to ensure that the stock market goes up forever, for lack of a better term. It's what we've seen time and time again. I mean, we could say all day long the Fed's dual mandate is full employment and stable prices, but when do they actually cut rates? And when do they actually expand their balance sheet? And it's not when full employment and stable prices are threatened, it's when stocks and financial stability are threatened. So I hope you guys enjoyed this video. I hope you found it informative, a bit of a departure from what we've done previously, and also a bit more lengthy than other videos I've done here on the channel. But again, if you enjoyed it, make sure to like if you're watching on YouTube, and like and share if you're watching on X. I'd really appreciate it. Make sure that you retweet this video, get it out to your friends, and of course, follow my account and the Theya account for more. That's all for today's video, guys. I'll talk to you later.